I see the monthly reporting as having two distinct sort of advantages or sort of favourable outcomes if it works well. Firstly, as part of our planning process, as any external audit planning process, you do have to assess the control environment. It's mandated under the auditing standards. You've got to go through the control environment and make an assessment of whether it's strong, weak or whatever. And part of the control environment, there's a number of key controls that we look at, and one of those key controls is what we term monitoring controls. And it comes up under the COSO framework. It was on Adam's slide. And a monitoring control varies, but one of the key monitoring controls that we look at is monthly reporting. So I mean, if you've got a robust monthly reporting process in place and it's operating and it's being used properly by your management, your senior management, we would give that a tick, and then we would that helps us as far as assessing your control environment, and then that can determine how much substantive testing that we may or may not have to do at the end of the year to give you a final opinion. The other key area in relation to monthly reporting, which I think has become sort of like the most important thing I think going forward, is this whole concept of early close work. Like it'd be 10 years ago, I don't know if people have been around that long in the public service, but we used to have 4 months to sign off the financial statements for all statutory bodies and departments. So that was just great, fantastic. But government's changed, the world's changed, so now we've only got 2 months. So QAO had to do things differently, management had to do things differently. I think the whole early close concept, call it hard close, soft close, whatever you like to call it, it is very, very important. We've got to try to somehow find a way to reduce that massive load of that we used to take on board. We're still signing off on about 400 sets of accounts. That hasn't changed. We just only got 2 months now to do it. So we had to find ways of doing it better, doing it more smarter. Early close stuff is a good example of that, and that's why I suppose we've been trying to push it for a long time, and I think the departments and stat bodies are generally coming on board now. I think a key thing which was brought up by Adam in his talk was it's all right to do monthly reporting, that's okay, that's fine, but if it doesn't go anywhere, or if it doesn't do anything in the department, or the EMB or your management groups or whatever really don't take any action from it, then for us, it's no point to us. As far as control or reliance go, we just say, well, nothing happens with it, it just sits on a table, no one does anything with it. So we would just assess that as just not being able to rely on it, and then we just move on and try to find other controls, or we go and have to do more substantive testing at the end of the year. So you not only have to do it, but you have to do something with it. Your senior people have to action, and we have to see evidence of that. I think as far as monetary controls go, I think Adam went through quite a few examples. I think from an external auditor perspective, although they're the type of things that we might go in and look at every month and just see exactly the type of reports that you do produce, like having a look at your ratios, your trends, your budgets, your forecasts, like the monthly P&L and balance sheet. I suppose that's an interesting one. I know over the last number of years I've had a number of the power, the energy sector. I looked after CS Energy and Ergon and Energex, and it's interesting. I used to notice a big difference, like years ago, the big difference between the for-profit, not-for-profit sectors and this monthly reporting. Those sectors were quite robust. They were done well. I think you just pick up that whole perspective where the boards, where they're living and dying on the bottom line, that those monthly reports were so important, and they had to happen really quickly, and there was always actions taken on it. I think what I've seen in recent years is the stat bodies and the departments have improved in that space. I've just come off the university sector in the last few weeks, and certainly they've really improved around that space when I go to all the audit committees and we review their work papers and that. And I think the departments and stat bodies have come a long way, and I do agree. I think hard close maybe something a little bit down the track, but certainly the soft close, early close type procedures really do have to happen for everyone to try to meet their timelines. As I said, management need to use these. I think from a debt perspective, we specifically go and look at the minutes that come out of the Executive Management Board, the Budget Committees, Investment Committees, Audit and Risk Committees. So we will continually look at those minutes and see what's happening, and that certainly helps us sort of sort out our strategy going forward to see if we have to change anything from what we decide early in the year. So that's the monitoring control. Getting into the early close, which I've sort of touched on already, I think ultimately what it's trying to do is that we're trying to move this massive hump of work that we used to do in your August, try to move a lot of that forward into, say, May, June or April, May. And if this monthly reporting works well, it gives us the opportunity to do that. And it doesn't just help us, obviously. We've got certainly a vested interest when we're trying to sign 400 sets of accounts in that last couple of weeks of August and whatever. But it helps management too, so we can get out of your hair, you can move on to your life. You don't want us hanging around causing you grief. So I think it's just good for everyone if we can get that going. I suppose the actual concept of early close, if people have been through it, basically what we try to work on is if we come, if you've got a March or an April, if you work on those reconciliations or month ends at those months, we can come in May, June, and we can do a lot of early testing on those balances or reconciliations or your statements that you produce then. And basically, if that all comes up okay, we really only have to come back in August and maybe pick up on any of the big numbers that might have changed, any material variations that might have happened in those last couple of months, and then just maybe do some analytics to confirm that final trial balance number. So we don't have to sit there and spend copious amounts of time ticking off transactions like maybe we used to do many years ago. My experience with it has been that not all balances are conducive to it. I think the big one, and I think the one that we really do have to get across is non-current assets. I think in any of your entities, I would suggest non-current assets will be your biggest number in your balance sheet. It'll be your biggest number. It impacts impairment, impacts depreciation, impacts revaluation. I think that is one where it's a classic that if you can get it done by March or whatever and get your reports out, the fact of the matter is for things like building, land, bridges, roads or whatever, there's a 99.9% chance that those numbers are not going to change. If you get the work done in March, get the report out, we can verify it. Between March and June, it's just materially it won't change. It'd be unless you had a cyclone or something like that would blew the whole thing down, or floods or whatever. So I think property, plant and equipment is a really good balance that we can work on this and get it done. We only have to come back then in August and almost just check any major additions, and that'll be it, and we can tick the number off. And that saves a lot of time, and that's the balance that causes everyone most grief. From my understanding and my experience is that if there's going to be qualifications or modifications of opinions, it's often that number around your property, plant and equipment, because there's so many estimates, there's so many assumptions, there's so much judgment involved. I think anyone would know you get 10 valuers in a room and ask them to value a building, you might get 10 different numbers. But it's about their methodology and everyone getting on board with it and agreeing on it when we get there. I think we've talked about, Karen talked about this. I think it's really, an ideal early close would be us going and checking your monthly balances, say end of March or April. And then if you're able to produce a draft set or pro forma set of statements with maybe last year's numbers filled out and all your policy notes there, we've all agreed on the new accounting standards and your policy notes that you've worked on with us during the year. If you're able to give us that set sort of like May, June, then we can get in and start agreeing numbers and agreeing words, and that gives us an early start, and then we just populate the final numbers when we come back in July, August to when you got your final trial balance. That'd be a nice way to go. I think the point out of it is that we've got to try to treat the whole month process just like the end of 30 June. Try not to treat them as a different process. I think in the old days sort of did your month stuff, but the end of 30 June was sort of like mayhem. We try to smooth the work out and try to treat the whole thing as just another process at the end of the year. That'll be the way we've got to try to work. And I think the final thing I'd like to point out is that Karen mentioned it, but my technical people only advised me a week or so ago that New South Wales, from my understanding, have actually now mandated early closes for the New South Wales public sector. I think it was the 7th of February or something. So, I'd suggest that, it may be on the cards that it's going to happen here as well. So we may as well get used to it and may as well start trying to make it work.